Hello, this is Richard Pears from Finextra TV, and I'm delighted today to be joined by two great associates from AFME. I've got Tonia, Associate Director of Policy, and I've got Rick, who's MD at AFME, joining us, and we're going to have an interesting conversation about a report they've put together, and particularly around the growth of obviously sustainable finance and the policy, the regulatory efforts, etc. There's a big impact going through the financial services industry. And so what I wanted to hear from is Rick to tell us a little bit about who AFME are, and then we'll talk a bit about the report with both Tonia and Rick. So hi to you, and Rick, tell us who are AFME and a bit about you.
Richard, we're delighted to be here today. And just by way of background, AFME, which is the Association for Financial Markets Europe, is a trade association covering the pan-European capital markets. Although we're based in London, our remit and our focus is actually EU27, a pan-European geographic capital markets basis. And we have offices in Brussels, London, and Frankfurt. I run our capital markets event and membership team, and our goal is to represent all capital markets issues in equity, fixed income, and other areas that impact the capital market side of the major banks. We also have a major prudential division, which is relevant to this discussion because it's actively engaged with sustainable finance initiatives as well. Tonia?
Thank you very much, Richard. Delighted to be here. Likewise. My name is Tonia Plakhotniuk, and I'm Associate Director of the Policy Division at AFME, and I lead AFME's program on sustainable finance. As you know, banks and capital markets have a crucial role to play in helping the economy to transform into low carbon and sustainable more generally. And we work with our members to ensure that our voice is heard by the EU policymakers when they shape the new legislation and regulation in this space.
Fantastic. So in that regard, then, you've got with the EU Sustainable Finance Strategy, they put out a consultation request, I suppose, and on behalf of your members, you've responded with this report, which is available. Tell us a bit more about that and sort of, the background to that, and then, perhaps talking around the transition to 2050 and the net zero carbon future. So I think, Tonia, give us a bit more on the work you've done there, which is very impressive.
Yes, sure. So it all started primarily with the EU Action Plan on financing sustainable growth back in 2018, which revealed a set of legislative and non-legislative measures, again, to help the economy to transition. It followed with the release of the European Green Deal in December 2019. And essentially what the action plan and the European Green Deal are saying that massive investments will be needed both on the private and public side to help the economy change essentially towards the 2050 decarbonization targets consistent with Paris Agreement. So these renewed sustainable finance strategy consultation essentially a precursor to EU strategy on how to channel private finance in particular, again, to help the economy.
And then the consultation is quite exhaustive, isn't it? Asking about all the various sort of measures and areas that can be focused on, from tools and techniques and data to policy and you name it. So the one question that I wanted to ask you, which I think allows you to give a sense of some of your response, is that many people feel that this is a climate crisis, and yet the world isn't moving perhaps fast enough. And I know we all probably saw yesterday Bevis Watt, CEO of Triodos, put out a piece where he was saying, there needs to be penalties and real incentives, around assets and banking, etc. How did your members in the report, look at the areas of incentives, I suppose, as that was a question that came out of the Commission?
Yes, I think I'll try to respond like in maybe 3 pillars. First of all, saying that obviously, like I said, banks have a critical role to play because they're seen as essentially blood vessels channeling the finance, the capital where it's needed, and clearly now it's needed in the direction towards sustainability. However, we think that now it's the time for a holistic approach where all stakeholders, both public and private sector, should put in joint efforts in order to really achieve their strategy. And we think that banks absolutely, they have capacity and willingness to help that structural transformation, but we both banks and real economy sector would need some clarity from governments on what exactly would need to be made, changed and made across different industries to help them transition. And this would need to consider the available resources as of the moment, different stages of where different industries are in different jurisdictions, even within the EU, and also the available technology. Like, for example, the energy sector is still very much dependent on oil and gas, and you cannot just switch it off and transition overnight. So those factors would just need to be taken into account. And we think that if we want to move towards that clean, sustainable economy in 2050, a clear roadmap would need to be laid out on how this needs to happen.
And Rick, some of the things, the incentives, and I know you spoke in the report about, a phasing in removal of tax benefits and subsidies to high emitting companies. These sort of things are part of a transitionary process, where people like, Triodos speak about changing the risk-weighted assets, so it's currently about sort of 20% capital reserve for carbon emitting industries and 75% for renewable industries. Your feeling is it's this transitionary piece which is key, is it, to allow the unwinding of the carbon economy in a sort of ordered manner?
Yes, the Triodos article raises a lot of important questions, and as Tonia mentioned rightly early on, the banks are an important part of the solution, but not the only piece. And there's three sectors between, she mentioned public and private. Within the private sector, there's actually three core groups that need to be aligned in how they have incentives work. There's the issuers, the large corporates, whether they're green or non-green. There's intermediaries like banks in the middle or insurance companies, or there's permanent investors, which insurance companies can be permanent investors, but there's also lots of others like private equity, fund managers, and institutions like that. The disclosure standards and the incentives have to be aligned. And one of the objectives of the Commission's overall green program is to create the incentives economically for issuers to want to issue financial instruments which buyers want to buy at the right prices to create that motivation. With the banks in the middle, either as lenders or as capital markets arrangers or traders or research providers, to provide incentives for that mechanism to develop on its own as quickly as possible.
Yeah. It was interesting, in that regard. I don't know if you noticed yesterday that Microsoft and Unilever and 11 others actually came out with an approach that they're taking, which is going to make them climate neutral to the 1.5 degree target. And they don't just want to look after themselves and their scope 1, 2, 3 emissions, but also come up with tools and techniques and do purchasing of green energy and so on and so forth. So I suppose all of those elements you're talking about, the corporates, the issuers, the asset owners, and the asset management, as well as policy, etc., all coming in harmony. I understand. So one other key question, Tonia, that you raised in the report that I looked at around risk management, was raised, and what's the role of risk management? Obviously, a central function for the financial services industry. How does it play out in this part of the world?
Yes, sure, and it actually relates to your previous question on the fact that maybe banks could be or need to be penalized for lending to so-called brown sectors, and we strongly believe that the risk management framework should, like the principles of the risk management framework should remain as they are, even concerning the environmental risk management. Basically, we think that these categories of risks should be incorporated into into the existing framework, based on the objective scientific evidence that would allow to, again, measure that risk. So we don't think this should be a separate category sort of on top of what's already there. And there is an argument that, well, brown assets might actually have higher risks, and that's why they need to be penalized, and that's why banks would need to be penalized. But if we're saying we're admitting these risks do exist, but we're just saying they should already be reflected through the internal risk management models of the banking system, rather than through an additional sort of layer of, I don't know, capital charges, for example.
Right, understand. And Rick, I don't know if you want to add anything to that one.
Yes, the issue of the green supporting factors and brown penalizing factors has been rightly, I think, discussed at the policy level. And as Tonia mentioned, the large banks all have extensive risk management teams, and the capital framework developed at the global level and the European level has rightly focused on capital charges that are associated with certain levels of risk. If you start entering distortive factors to basically achieve certain policy goals, you're turning those financial institutions into political institutions. And the large banks, for example, they're all owned by shareholders. They're not public in the sense of state-owned institutions. If you have a state-owned institution, it rightly should be subjected to other political views. From a bank's perspective, they're motivated at the board level, at the shareholder level, to look at how to develop the best returns as well as other factors over the longer term. So our members do feel strongly that capital charges should reflect risk. If you get back to the investors, who are really important and essential to this whole process, it's important to step back and look at the incentives that they have for green equity loans and bonds at prices which make sense for the corporate issuers. And it varies depending upon the type of investors. For certain investors, tax incentives can really make a big difference, particularly for the equity in instruments to motivate people to buy the risk capital that really we need to move the green agenda forward. Others, for example, the asset management side of things, it's disclosure. So they can then make the case to their pension fund asset owners, and the asset owners' governors, the board of directors of the pension funds, they can decide how they then want to allocate their money based upon their asset owners' policy objectives. That's a really important distinction.
Yeah, I see. And I mean, interestingly, just as a follow-on to that, the asset owner community seems to be getting quite progressive. And if you look at just the Church of England pension fund as one illustration of one that's getting quite progressive and saying, look, we're very much on this agenda. So as they provide their mandate then through to their asset managers, and I know they've done a lot of work with people like London Stock Exchange using the Transition Pathway Initiative, are you saying it's that sort of reflection coming through to the managers which is needed before you get the response?
Absolutely, because the asset managers work for the asset owners. They have contracts, they have investment contracts, and then so it's up to, for example, in the Church of England's case, is to make a policy decision. What are their overall objectives? Is it, for example, ESG only investment? And how does the overall rate of return factor into that? In the last few months, there's been some statistics that have shown that on balance, many ESG related funds have actually outperformed non-ESG focused funds, although that varies from time to time. And the key issue, however, is the fund management community will be reacting to what the asset owners tell them to do. And that will vary case by case. Some asset owners are only interested in maximizing return rather than social objectives. Other funds will be very focused on social objectives. And that's where the marketplace needs motivation and incentives. It's a really important area.
Yeah, absolutely. That's great for that clarification. Thank you. Now, when we come to the thorny question of ESG data, you've touched on this in some detail as well in the report. Tell us a bit more about your observations there, Tonia.
Sure. So basically, the question of the availability of ESG data is quite acute. I mean, frankly, it's been only maybe a few years since some of the voluntary frameworks have been established at the international level to encourage companies across the world to report on E, S, and G. And those, I would say, there has been good uptake, but still it's not really mainstream. But clearly, with the ambition to reach by 2050, there is a need for, I would say, all companies that have environmental, social impact to be able to report what environmental and social impact they have. So what our members see in particular is that it's indeed there is an insufficient level of disclosure by issuers, by corporates, that frankly this is due to the lack of harmonized standards established and primarily internationally, I would say. So what the EU has done recently, they've launched an initiative to establish an EU-wide sustainability reporting standard. And we very much welcome that initiative, as we think that would help bring in that comparability and reliability of data, especially if additional assurance procedures are established around that data. So we would very much welcome that. We also think there is an acute issue of accessibility of that type of data by, well, especially smaller market players like SMEs. Clearly, there are a lot of ESG data providers, but the concern is that, well, first, they're quite costly for the small businesses. Second is that the output or the data provided by those ESG data providers can vary significantly for basically the same issue. So another concern regarding the reliability of that type of data. So we do think that we do see a merit of having some sort of centralized resource at the EU level to help promote accessibility and affordability of that data. We do understand that it would take a while still for the reporting standards first to be established and then for the companies to start reporting on them. So we are very much in favor of innovation, digital tools that could help the collection of that data in the meantime when the action is needed.
Yeah, that's an interesting correlation, because it's 2050. Is a long way out. If you're in the science side of climate crisis, that's too late, right? So when you look at the tools, which was another piece that you went on to in the report, you obviously touched on the use of geospatial data and then gathering that data and analyzing it using machine learning and artificial intelligence, and using some of the innovation labs of the various banks and central banks. Tell us more about how people could get activated and what your thoughts were in that area.
Yeah, like I said, we very much encourage the synergy of the digital transformation and sustainability transformation. Technology more generally seen as the enabler for the change of how we live, how economies operate, and for optimization of many processes. So it should absolutely work as an enabler, to change towards a low carbon economy. So you rightly picked up that we believe that such existing tools as artificial intelligence and machine learning can really help deal with some of the issues that I mentioned, like, for example, the availability of data. They can collect the information that is otherwise is not available, geospatial imaging. Those tools can help process volumes of information and sort of unstructured information somewhere in the world, just and help deliver some meaningful decision, useful information that can be used going forward. We think because this issue is so important and requires attention immediately, I would say, we would encourage some cross-sectoral approach to data sharing among different sectors. That could be on the data on CO2 emissions, energy use, climate risk mapping, and frankly others. So we do encourage EU policymakers to really maximize that potential of digital tools, and we know that that's another big priority on their agenda. So we would welcome the tandem.
That's fantastic, and I think that I may get the name wrong, but it's the EU sustainability platform, which is one of the next steps they're moving into now, which might be the mechanism, if I've got that right. Rick, we covered quite a lot there around ESG and tools, etc. Was there anything that you wanted to add to Tonia's comprehensive answer?
Yes. What Tonia described, I think, is the reality of competitive forces for data, not necessarily wanting to convene. There's a very strong element in competition among the different types of participants, whether they're corporates, banks, investors, data providers, or other, I would call it, market infrastructure. And the European Commission's program is intended to motivate competition at all levels where it can.
Okay.
We do feel the taxonomy, which was an important part of this whole puzzle, is really important, however, because what you don't want people is endlessly creating their own taxonomies, because that will diffuse understanding, harmonization, and the ability, particularly by the asset owners and the asset managers, to evaluate really what is green.
Yeah.
There's been a lot of discussion in the market about greenwashing, about whether investments held by various types of funds that call themselves green, whether they're in equity, loans, or bonds. That's still, I think, a very much real concern in the market, and the taxonomy can do a lot of positive impact on that. What the challenge is how to motivate these disparate competitors in markets, including data providers, to actually develop toward a standard which commercially motivates people to follow them. And that process probably hasn't been completed yet. That will be ongoing for quite a while. We in the banking sector fully support that. The banks have an important role to play in helping and motivating and moving forward with those a set of standards that work for the corporates as well as the buy side. But getting back to one of the things I mentioned at the beginning, the alignment of all these standards is really important, because if the banks as intermediaries, whether as lenders or as market arrangers, can't get the data from the corporates, which will eventually throw through the banks to investors, or directly from the corporates to investors, the standardization and the comparability is going to take a lot longer. So we do think there's a lot of urgency to try to focus on that as quickly as possible.
Do you think, I mean, on this, there's some places standards are needed, and as you say, some places they're not. I mean, you need standard reporting because we need to know, that output, and we need to then benchmark it. In terms of the data, you need to know the provenance of the data, but it doesn't necessarily need to be standardized because, of course, it can standardized in its technical format, so you can read it, but not standardized in where it came from. If I take some satellite data, that might give me a unique edge, as you were saying. And as long as in my reporting, it's clear where that came from, I would imagine that's okay. So we talk about standardization, but there's layers where it needs to be standardized, technically, reporting, but then where it just needs to have an audit trail from where it came from. Is that right?
Yes, absolutely, Richard. Essentially, the point around standardization that we're making here is that it's important to have standardized reporting to an extent to promote comparability of that information. Like for investors to look at different companies, they need to understand what possibly key performance indicators are pertinent to maybe different types of companies or sectors, so that they can compare and make their investment decision. However, I do agree that especially in this space, when it comes to data itself, it can serve as an addition, or again as an enabler, right, to the any standardized reporting requirements as such, because especially with the digital tools, you can get that information externally that might not be even available from from the reporting entities.
Yeah, and then that allows your market dynamic to happen, Rick, doesn't it? Because some people are, yeah.
Yes, our association has been very engaged on a very similar data standardization and collection exercise through the European Commission on MiFID, the Market and Financial Instruments Directive, that's been outstanding for a couple of years. And its goal, rightly, was to improve transparency in the reporting of trades in equities and fixed income and other instruments. And the system is developing. It's not quite there yet. Our members still recommend quite a few tweaks to make it easier to understand, more consistent. But I think in the context of sustainable finance, there could be what's happened in other product areas is basically development of a minimum set of reporting standards which are harmonized, which everybody agrees are necessary for comparability. But then you can have other optional fields reported which actually maintain an element of competition. And that already happens. For example, lots of the analytical data providers in sustainable finance already provide a lot of data beyond what people might consider bare essentials, and people are willing to pay for that, and we want to encourage that. But I think the core for the next stage of this policy discussion is what are the fields and what data are the minimum that everybody needs.
So that's a really comprehensive review. Tonia, tell us what next and what else can we expect from AFME?
Thanks, Richard. I probably want to reiterate that transition process will be key, and it would be pivotal for both the private and public sectors to work together to ensure that that transition is sustained. And we and the and the private sector really need some guidance and clarity from governments as to how this transition could happen and what exactly would need to be done and expected from private sector to just achieve the objectives that the EU Green Deal laid out to achieve.
Gotcha. Rick?
Yes, just to build on Tonia's comments, what we're calling for is really further clarity, and there's a lot more work to be done in terms of developing industry-specific roadmaps that fill in blanks in milestones between now and 2050 that create more accountability, more measurability, and more deliverability of getting closer to that low carbon goal. That includes collection of better data, includes developing stronger public-private partnerships, and it includes a stronger sense of risk assessment. So what Tonia mentioned is the interaction between us and policymakers is really essential to doing that, but we feel there's still a lot more work to be done. But the Commission broadly, I think our members feel they've done a pretty good job in pulling together the right initiatives so far. There needs to be a further push urgently to keep this going.
Fantastic. Great point on which to finish. Thanks so much for your time today, Tonia and Rick.